Yesterday, Westpac was the first of the banks, but as Alan Kohler said on the news last night, they'll by no means been the last of the banks to put up residential mortgage rates, both for principal interest and interest-only loans as well. What does it mean? For every winner, there's a loser. Martin North is Digital Finance Analytics Principal. He closely observes these things from the point of view of economics. Morning to you, Martin.
Hello, John.
Winners and losers. Who wins, who loses?
Well, if you have an existing mortgage, either interest-only or principal interest, investor or an occupier, you will lose if you're with that particular bank. If you are a new borrower looking to refinance or perhaps to buy for the first time, there are some remarkable deals out there. So absolutely winners and losers. Unfortunately, more losers than winners, I think.
The Australian property market, particularly residential property, has been overvalued. Indeed, it's been described in some circles overseas as well as locally as a bubble. So I guess there was always going to be a correction, was there not?
Well, yes. I've been talking about we're way over the long-term norms for years, 40 to 50% over what the ratio should be. So this is more than just a bubble. This is a structural problem we've had for a long time. Now, of course, we're seeing prices beginning to slide. At the point when people have got these huge mortgages, so they're highly leveraged, and put those two things together, and we are looking, I think, at a rather worrying trend over the next couple of years. So this is, again, something which is not going to recorrect itself anytime soon. This is part of a longer-term thing about the fact that credit is less available now. As a result of that, home prices are going to continue to slide.
Well, if you've bought in at the top of the market or near the top of the market, yes, that's a problem. But of course, that's a very small proportion of the overall property owners. And the other issue, of course, and everyone says this must be addressed with some urgency, is the problems for first home buyers wanting to get a start.
Yeah, it's a real problem because home prices in absolute sense are so high. Anybody buying in, first-time buyers buying in now, will be buying in at a very high point in the market. And so the risk is they buy and then prices slide from under them. As you say, people who've been sitting in property for a good number of years will have at least a paper profit, although currently if you then try to sell, you'll probably have to ask less than you think that you would have previously, and even then you may not be able to sell. So, yeah, there's a bunch of rather critical issues here. Frankly, we have a public policy failure in housing that is a generation in length, and we're not going to fix it overnight. But I think it's really time for the government to begin to think differently about the fact that housing and lending is not just a growth engine, it's actually got to be thought about from a community perspective.
So let's keep an eye on the market, and yes, there may well be some people who can't afford what they've taken on. At what point, though, do we need to start ringing alarm bells about more profound risks to the whole of the system? At what level of defaults or panic selling do we say, whoops, hang on, this is starting to look ugly?
Yeah, so what's happening at the moment is when people get into difficulty, the banks are very keen to work with them to try and work it out. So at the moment, if you sell, you can probably sell and repay the bank, so the bank's happy. So what we're seeing is absolute level of defaults low, but the number of people getting into difficulty and having to sell and get out is rising quite significantly. We're also seeing a spike in the 90-day default rates, which is a worrying leading indicator. But ahead, my view is that we're going to see more of this because incomes, of course, remain flat, cost of living continue to rise, mortgage rates will continue to rise. I think the others will follow suit, the other major banks, somewhat, not necessarily quite the same way, but somewhere or other. So we've got this significant and profound pressure. But the thing I'm most concerned about is the economic impact, because if people are actually struggling to pay those mortgages, and more than 1 million are, they're not going to spend at the shops. And it's that broader economic impact then that will have a second-order effect on the growth of the overall economy, and the Reserve Bank's been relying on the household sector to keep the economy buoyant.
Yes.
So you start to see some of the cracks appearing, and while superficially the growth may look pretty good, underlying it, I think there are some structural issues.
And the other category I'm concerned about, Martin, are those people who are heavily leveraged, heavily geared, particularly negative geared property empire builders, people who have thought that the consistent upward trajectory of Australian residential real estate was going to go on forever. And I'm concerned that some of those people, and I'm sure they're lovely people, but they may have bitten off more than they can chew, and the domino effect kicks in if they suddenly don't have the settings, the economic settings that they've taken for granted. What do we do about that?
Well, you're right about that. So we're seeing in our surveys, we see a lot of households who have leveraged up with multiple properties. So they take the equity from one and put it into the next and then put it into the next, often with interest-only loans as well. And, for a generation, prices have only gone one way. So they looked as though they had a winning bet. However, just as the leverage works on the way up, it also bites on the way down. And we're already seeing some multiple property investors, for example, being forced to sell one of those properties to try and liquidate capital to be able to support the rest of them. As prices continue to slide, that's going to get worse. Negative gearing, of course, which also encourage people into the market, and I think it should be removed, by the way, because it really just contaminate the market, makes investors way more winners than owner-occupiers. So, yeah, we've got this pressure now. And the trouble is, as properties slide further, then if you're an investor, do you sell and get out quickly? Do you hope and hold and, expect that perhaps prices will recover next year as some of the real estate sector are?
Or do you salvage from the wreckage what you can now and get out before other people are also trying to get out, in which case it becomes a snowball?
It's a rush for the exit. I'm already seeing that rush in some postcodes in Sydney and now in Melbourne, in the city areas, where effectively people have been highly leveraged, particularly these high-rise new apartments where they bought often at the top of the market and often, frankly, it's a premium.
And with a so-called rental guarantee, which doesn't mean much in the overall scheme of things.
It doesn't, unfortunately. And, of course, now what's happening there is that if you look at rental returns, they are really being squeezed as well. So, effectively, you're seeing home prices begin to slide, rental returns very much now being constrained because rents are more associated with income rather than home prices. Mm-hmm. And so the economic proposition of property investing, I think, is busted.
Which is a huge mind shift for a lot of people. Martin, thank you for your clarity this morning. Digital Finance Analytics Principal Martin North, economist, speaking to us about where mortgage interest rates are heading.